going on, everybody? This is Dave Bath and Beyond, where we're all about mortgages and more. And this lovely lady is...
Bathsheba with Gross Capital.
And I'm David Dowd of David James Investments, my company, working with Equity Smart Home Loans as my broker. And we can do over 100, well, we've got, I think it's over 160 different banks that we can work with. And before we get kicked off, we are going to be talking about Fannie Mae guidelines today. So, of course, always take what we say with a grain of salt and always do your due diligence and check the guidelines because they can change at any time. Today is December 9th of 2024. When we're recording this, I'll put that up here as well as a link at this moment where you can follow along if you want to check out those guidelines as we go through it. All right, folks. So today we're going to be covering Chapter B2-2, the borrower eligibility, and we're going to be covering the general borrower eligibility requirements, non-U.S. citizen borrower eligibility requirements, multiple finance properties for the same borrower, and lastly, the guarantors, co-signers, or non-occupant borrowers on the subject transaction. So we'll get it kicked off here with the first section.
There is no age limit for borrowers. When we were getting our license, we learned about that through ECORA, types of discrimination. So that's one of the discriminations. There's no age discrimination. So you can be 99.9, and if you want to get a loan, by law, we have to get you that loan. Or if you're 18, you have to be at least 18 years old to show that you're adult age. So if you're 18 years old and you want to get a loan, they can't be like, well, you're too young to get a loan, or how are you going to afford it? Hey, if you can do it, by law, they have to give it to you. And if you've been discriminated by that, then I suggest, talking to an attorney or talking to someone about that, because that is the opportunity for everybody. Exceptions to requirements of a borrower: you have to be a natural person, you have to be a human being, and at least 18 years of age. Or if you have an LLC, then, that's what it was talking about, a revocable trust, which means that you put your house into a trust and then you want to give it to someone else, and that's going into another realm.
With the natural persons, when we first read that, and especially in this day and age of like, oh, AI this and AI that, thinking, oh, we're talking about robots? It's like, well, not yet.
Right.
But for the time being, as you were mentioning, Bathsheba, definitely entities. That's the big one there. So LLCs, partnerships, corporations, right. S and C corporations, those are entities, and those count as people in certain contexts. So, and it also has that shield with LLCs, right? That limited liability shield that we have against the law. In case the company is sued, then you don't have to pay your assets, liquidate your assets in order to pay out to whoever felt was harmed. And, America is, the United States of America, I should say, be very prominent for people being sued back and forth and class action lawsuits. And so those types of things are important. So natural person, it's really referencing that in this case. But beyond that, with the ages, right? So state to state, it's going to be different. I believe there are some states where it can be under 18 under extreme circumstances. I can't remember off the top of my head which states those are, but I'm pretty sure it involves like somebody of whatever they deem the legal age of an adult and that kind of thing. So obviously, as time progresses, that may also change. Hopefully not, because again, based on what we know about brain science and so forth, it's just being able to make really big decisions in life should only be expected to those who have fully developed and fully have gone through that growing process. I remember when I was young, there were certain things I really wanted to do, but dear God, if I did those today, it just would not be good for a lot of things, health, family, whatever, right? Like just too dangerous, too risky, things like that. I think that's what they're trying to establish here, but they don't actually set what that age is because they're trying to adapt to all the different states, and maybe they change and they won't have to update this page if they change because they never really said what that specific numeric age is. They just said, hey, there's no maximum age limit for the borrower, which I think is kind of weird that there would even be an age limit beyond a certain point, because you're thinking, okay, so 78-year-old grandma, grandpa wants to buy a house, and I don't know, this says anything about sound mind, dementia, whatever is an issue. I'm not one to judge. Obviously, what they're trying to establish here is regardless of that, Fannie Mae's cool with it. Let's go. I hope that those folks that are going through those issues have the help they need to make the best decisions possible, because your mileage may vary, as I've said many times.
As long as you can go through those documentations, because it's a lot of documentation. So if you're 78 and you can do those documentations, then you should have that right to do it. So I like that they put it out there, or even a co-signer. So we'll talk about that as well. You know, you can be a co-signer. There's no reason the co-signer can assist a parent or a grandchild or a loved one. I did want to talk about home style renovations mortgage. And what that is making renovations to repair or improve the total improvement totaling up to 75% of as is completed appraisal value of the property with the first mortgage. Like a refinance, get the funds to fix the house. So that will be an exception to an actual person.
We'll see also how that impacts the count as well. It's like what counts to how many mortgages you have. Further down the line there, of course. I love how they have the inter vivos as like a Latin, where it's the revocable trusts. And that's another entity, right? A trust is an entity, to what you were saying earlier, Bathsheba, that you can put your assets into a trust in the name of a trust. And that can also protect it from probate. And later in life, can also protect it from certain legal obligations, similar to that what we've seen with the LLC. There's a lot of advantages, and definitely get with an estate planning attorney or someone who has that knowledge to make sure you're getting done what you need to get done. But what they're just trying to bring up here is like, well, who can and who can't? And that's really what this big section is about. It says the borrower is any applicant, individual or jointly, whose credit is used for qualifying purposes to determine ability to meet Fannie Mae's underwriting and eligibility guidelines. Co-borrower is a term used to describe any borrower other than the borrower whose name appears first on the note. So credit, that's another big thing too. They're going to use that information to see, okay, what do you got going on?
Yeah, are you trustworthy? Do you have, that's how we're able to find out the debt. So when we do your application and then we pull your credit, that's where we can see all your debts. Do you have another mortgage on your debt? Do you have a car loan? How much student loans you have? Then what about your revolving credit cards? Are the balances big? And that goes, that is added towards your debt to income ratio. So that's where the credit is essential. And usually you don't get credit cards until what age? 18. So young people out there, when you get those credit cards, just cut them up. Ask your mom to put you as an authorized user when you're 12. You don't need a card. Just add you to authorized user and help her build your credit. Mom or dad or a friend whose credits are good, that's trustworthy.
Yeah, I usually would say when it comes to being under 18 and not being considered an adult, whatever state you're in, the best thing you can do, assuming you have your parents' consent or guardian's consent, is to get one of those preloaded credit cards where you have to put in a certain amount of money and you can only
credit card.
Go up to that amount. So you definitely don't put yourself in the hole too early in life. If you got the blessing of those who are in charge of you as adults of the house. So that, I think, is where you can start. You know, if you're watching this, you're 13, for example. I think that's the youngest age you're supposed to be watching YouTube. But either way, if that's you and you're really interested in finance, you're really interested in that, that's great. Take that same enthusiasm and use that to try and start to build things, whether that's to get investments early in a custodial account or building the credit card. You're building your credit ahead of time by utilizing those
secured credit cards.
Right. There's a few different ones out there, I think, nowadays, but the big one I think is Discover that I have seen, at least at the time of this recording. So definitely look into that and definitely get the blessing of your guardian or parents before proceeding. Very important. For the last part here, looks like it goes over the tax identification numbers and what can be utilized to identify a person. So of course, for most people, it's going to be a social security number. But for those of us who are just coming to the States from another country, welcome. Hey, we're glad to have you here. But on top of that, you have the individual taxpayer identification number, or ITIN, as it is commonly known in the industry. And so that can be another means to try and get a house utilizing information if you haven't got your social yet, or maybe that's still in a process. I know a lot of that can be a long process of getting a social security number and getting the proper identification, that kind of thing.
For those who cannot qualify the traditional way, we have a qualified mortgage in the traditional way. We have the non-qualified mortgages where you can use, if you don't have a social security number, if you have an ITI things in a foreign country, and we can get that translated in English, we can use that, help you get towards a home. If you, as long as you have a work permit and a tax identification number, you're able to get a home. You're able to purchase a home as long as you're able to pay the down payment, the 10%, 3%, 5%, and you show steady work, healthy savings. You can get a home. Don't let that discourage you if you're not a permanent resident. Speak to us, give us a call. We have other options for you to get you a home.
Make sure you check in and don't just throw in the towel before you get some answers, because until it's a no, it could be anything. So there's a lot of different circumstances. And so can't answer all those questions here, unfortunately. So definitely reach out if that is you. This also talks about the desktop underwriter. That's what DU stands for here, because they don't say that in this part of the context of where we're at in the guidelines. And loan delivery may identify data integrity issues pertaining to the borrower's social security number. So basically, we might get some conditions from desktop underwriter. We need to check on something, confirm something. That's just warning us about that here. It goes through some other means of identification, like the Form SSA 89, which is the Social Security Administration authorization form, I believe is what that is.
Mm-hmm.
And then let's see here, electronic consent-based Social Security number. So, we're going into that electronic realm. So they had to talk about that. Lender must retain a documentation on a loan file that evidence the validation of the Social Security number. So that's more for us and our people we work with. Lender must deliver the SFC 162 if the Social Security number is validated through the SSA. No discrepancy. And okay, so yeah, if everything's smooth, then we should be delivering documents. Of course, that's a big part of the mortgage industry.
So once you do your application, it gets sent to processing, who makes sure they have all the documents and everything looks good. Then it gets sent to underwriting, and underwriting uses DU and the LP, which stands for loan
prospector, I believe it was.
They use it and we use it as well. So basically, it is an algorithm. Thank you for checking. It is an algorithm that pushes everything through, and then it tells us if everything is good, or if we need some more documentation, which is the conditioning. It says, okay, everything will get approved. It'd be approved and eligible, or approved eligible. And what we want is approved eligible. When it's approved ineligible, or it could be denied ineligible too. We don't see that, but if it's approved ineligible, then it's like, well, we need to show proof that this is a valid security number. We need to show proof that they work here. We need to show proof. These are the conditions that we need to approve the loan completely to get to the next step of getting to the closing table. So those are the strict terms that I want you guys to understand and to be patient with the process. So if your loan officer is telling you, well, we need this information, we need this and that, and it's like, oh, every time it's something else, it's something else. Mm-hmm. Well, we're just trying to prevent the 2008, and like David always says, that cookie cutter loan. So we're trying to get there as much as we can.
Definitely treat your loan officer with some kind, courteous behavior, because there's definitely going to be quite a few things we're going to ask for depending on your situation. But I think also bring up those concerns at the beginning of the conversation, because I feel like if you do that, then we can ask for those things right then and there and at least get a general idea of what direction to go. So it won't be so much phone tag in case that's something you're not a fan of. And also tell us your preference of communication. I think that's important too, to be very open about that. To answer your question earlier there, yes, Loan Prospector is the LP, and then automated underwriting system for AUS, and then desktop underwriter for DU, which is Fannie Mae. That's the one we're working on here, just so we know what those mean.
Establishing borrower's ownership interest. It's just a borrower must establish ownership interest in the security property and become liable for the note, whether individual or jointly. So it's basically saying if you sign it, you'll be responsible for it. If you're a co-signer, and they have something that we're going to talk about now, is a non-occupant co-signer. Even if you don't live there and you sign the deed or you sign the instrument, you will owe it. And if God forbid it forecloses, it will be on your credit report too.
Moving on over to the non-U.S. citizen borrower eligibility requirements. And I know we've touched a little bit on that so far in this conversation, So we're just going to go ahead and put because it's a very short section here
Yeah.
about that. So I'll go ahead and read it here for us. Fannie Mae purchases and securitizes mortgages made to non-U.S. citizens who are lawful permanent or non-permanent residents of the United States under the same terms that are available to U.S. citizens. Fannie Mae does not specify the precise documentation the lender must obtain to verify that a non-U.S. citizen borrower is legally present in the United States. The lender must make a determination, so it's on the lender, of the non-U.S. citizen status based on the circumstances of the individual case, using the documentation it deems appropriate. By delivering the mortgage to Fannie Mae, the lender represents and warrants that the non-U.S. citizen borrower is legally present in this country.
This is more like if you're a permanent residency, but you're traveling back and forth from your home country to the United States, or if you're here for business, you do a lot of business here. So like I said, going back to the non-QMs, if they will ask for the documents that's needed, we will go through the desktop or LP and see what additional documents, either from the taxes, from the Social Security Department or the IRS. It is up to us to decide, but don't give up. Let us try our best to get there with you.
And be open and honest about it. And I think the more open and honest and the more we're prepared for that, I feel like the better experience you ultimately have. If you like to hide things, you don't want to talk about it because, oh, I don't know what they're going to think. I don't know what they're going to say. Well, I mean, you want the house, right? So, I mean,
right.
it's that, or, we're going to be playing this whack-a-mole with information, and nobody wants to do that. Not even us. I feel like let's just be open and honest and know that we should be keeping this confidential. I know that tends to be a thing with lawyers and doctors. I haven't really seen it being a thing with the loan officer direction, but I would say for the most part, I wouldn't want to be giving my borrower's information to just willy-nilly. I just feel like that's just not a great experience. It's like, if you're going to trust in me, then you need to trust me with the stuff you're giving me, that it's just going to be for this situation, as opposed to it be going somewhere else outside of that. To me, I feel like that's unethical. So it's just one of those things where it's definitely make sure you talk to your loan officer and make sure that they do that just in case. I'm pretty sure that there are some legal stipulations of not doing it that way, but just be privy to that info that's like, hey, they should be being confidential with your information.
That's the good thing about our license as loan officers. We're going to know you more than probably your best friend. I'm sure your best friend doesn't know that your social security number, your taxes. We are going to be like your doctor, your psychologist. So it's important to trust us completely. We took the license, we did the background check to show our trustworthiness, to show our fiduciariness to be trusted. So we want you have to be transparent with us.
It's like we're the doctor of the finances if you're going to need a mortgage, basically. Long story short, right?
I like that.
Yeah, that's kind of what we have to be. Because we want to make sure also we have your best interest in mind. I feel like that's one of the reasons why it's really good to have an introductory meeting with the loan officer. Make sure they really click and jive with you as people. And then from there, I feel like it's just naturally, you're going to trust them. Okay, great. They have my best interest in mind. I trust what they're going to be doing as far as the mortgage goes. Let's give them what they need so they can help me. Help us help you, I guess, right? Long story short, if you want to work with us. So let's see, that's everything on here. Of course, like I said, mileage may vary on the citizen, but as Bathsheba has said so eloquently, make sure you bring the whole situation forward first before you throw in the towel. It'd be a real shame that if you could have, but you just didn't give it that extra time it needed to make sure that it could. Moving along to part number 3 here, multiple finance properties for the same borrower. This one is for investors, which I found there's a part in here I found interesting, but I'll talk about that here in a little bit.
I like the information box when it says principal residence, transaction other than home ready loans. Remember, home ready loans are typically you're buying it and then you're going to fix it up. You're going to take some money in it to fix it up. Maybe it's like a foreclosure home and you're fixing it up with some of the portions of the mortgage that you're receiving is to fix the home up. That's outside of that. So if it's a regular first-time home buyer home, you have no limits, which means you can refinance that home as much as you want to refinance it, as long as it's showing that it's a benefit to you. It has to be a benefit to the borrower of the reason why you're refinancing it. You cannot just continue to refinance and refinance. That's called equity stripping, I believe. And
I
that's
believe
more
you.
on the lender side when the lender is taking advantage of the borrower to get a commission, and the refinancing is not benefiting the client. The client is not saving $100, at least $1,200 a year or $1,000 a year. DU and LP will come in and be like, well, why are they refinancing it to a higher interest rate? Or what is the benefit? It has to be a benefit. But if there's a benefit, you can do it as much as you want to do it. It's just that every 30, you're just going to, extend it another 30 years, how many times that you refinance it. So that was a good thing. The home ready loan is up to 2%, and it may require a manual underwriting, which means a person really looking into it to see why. If it's a second home or an investment in all transaction, that means that this is your second home. This is not your primary resident. This is not your homestead. This is not where you get your tax benefits from. It's your second home, or it's an investment property where you're making profit, then you could do up to 10 times.
So I know we referenced DU and LP a lot here, and I know we're just specifically talking about Fannie Mae in these videos here, but just know that for those that are not in the mortgage industry, when it comes to Fannie Mae, which is what these guidelines are, and then Freddie Mac, which is a future episodes will be about, we'll talk about DU and LP because there's a lot of similarities. They are not exactly the same, but there are a ton of similarities, and they're both coming from the conventional realm. So when you hear conventional loan, that's what people are talking about. They're talking about Fannie Mae and Freddie Mac in most cases. Obviously there's some non-QM scenarios that we can get into later, but for now, whenever we talk about DU or LP, that's what we mean. So just to make that very clear, this table's nice because it quickly shows you what you can do. Now, I found it funny. This is the part that I found that was funny. It says principal residence, there's no limit to the number of finance properties. But I'm sitting here going, but isn't that because there can only be one principal residence at any given time? Otherwise, it would be a second home, would it not? So I was like, you don't need to set a limit because there will only be one if it's a principal residence. Unless you're playing some sort of fishy game that we've talked about in previous episodes, that should be number one and only one. Because principal residence, you don't have two mailing addresses. That's not like, I guess you could do P.O. Box technically, but that wouldn't be principal address in most cases. Right. Like a physical address, right? I think that's how they'll refer to it in the insurance realm. But yeah, so that I thought that was funny. And then, of course, the home readies, to your point there, we can have up to two of those going on at the same time, given that it's kind of a rehab. I think that's what a lot of people call that.
Yeah, rehab.
Hey, fixer-upper, right? I'm going to get some profit maybe. Either I'm going to sell this really quickly or I'm going to hold on to this and turn this into something. But you can have two of those on the Fannie Mae side of things at any given time. And then we jump into the second home and investment property, which is where a lot of people really like to know, especially if they're in the real estate investment gig. We're like, well, how many can I have? 10 is the number. And then how do we count that, right? That's what they talk about down here with all these examples and the what ifs and it's right on the line, right? So it doesn't count commercial real estate, multifamily property listings that have more than four, right? So 5+ ownership in a timeshare. Stay away from those. Personally, that's my advice, but take that with a grain of salt. Ownership of a vacant lot, so that's residential or commercial, and ownership of a manufactured home on a leasehold estate not titled as real property, or a chatelaine. That's French, I believe, on the home. So yeah, that one's a little bit technical at the end there. I don't think, unless that is your circumstances, you will be dealing with that final one there. But everything else I think is pretty straightforward, given that they are more risky. That is the reason why Fannie Mae doesn't count them. They're more risky, and they don't count because it doesn't fit that cookie cutter that Fannie Mae is looking for. So it does talk about a little bit above that, though, the number of finance properties calculations. So it wants 1 to 4 units, right, like we talked about, which is really useful, actually. If you're someone who can afford and get into 1 to 4 units, awesome investment opportunity, especially if you live in it initially for some amount of time. In most cases, a year. But that's great. You can rent out the other 3 spaces. House hacking. That's what they call it on the internet. So that's a lot of good potential there. Highly recommend if that's something you are into. Total number of properties financed. Let's see, not the number of mortgages on the property, nor the number of mortgages sold to Fannie Mae. So it's establishing, when we're talking about this count, we're not talking about, you have one property and it has multiple mortgages. No, we're not talking about those counting the second mortgage on that property. No, it's just one. Okay, if Fannie Mae's on there, it's just one, and hopefully they're the primary because
They're always the primary.
yeah, I don't think they're going to buy it unless they are, unless
Yes.
there's some sort of extreme. Like I'd be interested to see
Yes.
where they're the secondary and they still bought it. Like I think that would be
Right.
really interesting to see. Property, number of properties sold. Okay, with multiple unit properties. Okay, so again, multiple units counts as one property because it's a unit of said property. It's trying to establish that there. Borrower's principal residence, if it is financed, so that will count as one. But remember, just one, and you can't have more than one primary because that just how can you be in two places at once? And
Right.
then unless you're a video copy of yourself, the cumulative total for all borrowers through jointly financed properties are only counted once. So if you buy it with your spouse, right? It's like that's one. It's one for both of you, but it's still just one, right? So that's an interesting thing. So if you ever think about buying a home and you want to have both your names on it, but you all want to have a total of 20 properties, maybe not do that. If your credits are good enough to do it on your own, maybe do that so you can still have your 20. So then they've got some examples on the counting, which goes into really vivid detail, but essentially everything we just talked about is basically what's going to be shown here with the home
Yes.
obligations of the borrower, the co-borrower, purchasing the second home, investment properties, borrowers purchasing and financing two investments, simultaneously. Yeah, that's okay. It's fine as long as you can do it. I think that's the other thing too, because we look at DTI, right? The debt to income ratio. We look at a bunch of other things like their debts. So as
Yeah.
long as all of that checks out,
Serves.
on our way, right?
You just need additional reserves. So basically, when doing a second home, they typically want 20%, 15, 10 to 40% reserves. This is money that you have in a bank account that to show that you're able to cover your mortgage, cover any emergencies. And this is separate from your down payment.
When we talk about assets, that's basically what we're talking about. Another name for the assets is reserves,
Reserves.
because we want to make sure, well, at least the lender wants to definitely make sure that if hard times come,
Yes.
you're able to liquidate something to make your house payment. So depending on what home this is, as we've talked about in previous videos, whether this is a primary residence, it's less risk, right? Secondary home, a little bit more risky. And then investment property, probably the most risk of all of the different types. And then do we have enough assets on the sidelines, that being all kinds of things. Even cash on hand can count as an asset. It's not seasoned, but it can count as an asset, not for a down payment, but it can count as an asset. Okay, just because that can get very confusing for people. It's like, but I have the money right here. I can just buy the whole thing outright. It's like, well, that's fantastic. But if it's just in your hands, where did it come from? Can we trust that money? Like, is it going to bite us back later if we accept the money that you're going to give us? So it's things like that I think when they talk about reserves, it's just like the main thing you have to remember is, can I pay for my house if hard times come with these other things that I happen to have? So,
and I believe when you do stocks and your mutual funds, your 401k, it's about 75% of the value of that. And yeah, savings, high yield savings, other assets, yes, liquidity.
and your mileage may vary because these things can always change, and also depending on the product and things like that. Specific to Fannie Mae, I think, yeah, they want it to be accessible. So whatever assets you have, even crypto, just throw it out there and we will add it to the list and just see what sticks and what
Yeah,
percentages of those values will stick to, because it's going to vary. It's a very long-winded thing, but the
yeah,
more we have, the better. Multiple financed property policy to DU loan case files. This is just talking a little bit about the logic of how Desktop Underwriter, which is their automated system that runs through loan files, can determine risk from what is presented. So this gives us a little bit more ideas about that. Obviously, DU is changing all the time. Yeah, I'd say a lot about this, but then again, it could just change tomorrow. So I just say definitely read through it. For those of us that are loan officers or mortgage industry professionals, it is to your benefit to have a familiarity. But just know that that's essentially what this is covering here, and the different types of risks. It's a very big section. And we'll get messages from DU if there's anything off. Again, things we've already talked about here as well.
I saw the credit score minimum is 720, so they want that credit score really high.
Yeah, I was going to say, is that not like one of the best credit score possibilities for
Yes,
most people? I think it's 720. Rolls Royce of
of credit.
credit score. Yeah. Yeah. Is a Rolls Royce of what? No. Yeah, sorry. Not just the car. The higher credit score you have, the better. That's what that's going to
Yeah,
boil down to.
the better, the lower interest rate category you'll be in. And it's in ranges. So, they have the good, very good, excellent. Excellent is 780 to 850. So if you're in that range, you're going to get the same credit score as somebody who has a 780 or 805. It's in
Yeah.
that range.
Interest rates and then possibilities of different loan options. I think that opens that door wide open. So depending on what your goals are, because that's another thing that goes beyond finances, but it's like, well, maybe do an ARM. I don't know. You're going to be here for what, 3 years? So maybe that's an option. We've talked about these, I think, in previous episodes too, when it comes to creative financing. But the higher your credit score, the more options you're going to have. And the more options you have, the more likely you're going to have a situation that is beneficial to you.
Beneficial.
Let's just keep it moving here. We're getting to the last section, I believe, which is the grantors, cosigners, or non-occupant borrowers and the subject transaction. Subject. Okay, anytime you see the word subject, know that that means what we're talking about at that time. So
Yeah.
subject property, boom. Subject borrower, same idea.
Talking about the bar.
That's right. In this case, yeah, we're talking about the bar. But subject property is the one you'll probably see more often because we don't like to talk about people as items. So we got the definitions here. Grantors, cosigners are credit applicants who, and then quite a laundry list here of different things. They do not have ownership interest in the subject property as indicated on the title, sign the mortgage or deed of trust note, have joint liability. For the note with the borrower, do not have an interest in the property sales transaction, such as the property seller, builder, or the real estate, and meet the requirements of that page is referencing, except for the provisions related to establishing an ownership interest of the property. And then it goes over a similar list with the non-occupant borrowers. Non-occupant borrowers, you don't live there, but
Yes.
you're still a part of the transaction, monetarily speaking. Maybe you're helping a family member out, a friend.
Right. Monetarily, or your credit score is strong enough, you're reducing the debt to income with your income, but you don't live there. You're just a support, but you still be held 100% responsible for that home.
Yes.
So that's a big decision to make and take it wisely.
Absolutely. Be careful. I cannot stress that enough. I know you want to help,
Yes.
and don't let precautions take away from what you want to do, but just let it be the reason you're comfortable making that decision. I think if you really do some soul searching, really do some deep thought about what it is you're doing and why, and then who you're dealing with, you make sure you trust them to do what they got to do. Maybe they've proven themselves, maybe I don't know what it is that you're going to do, but super risky business because we're talking about your credit, we're talking about your profile as a borrower in the future, and about anything in the realm of credit, credit cards, car loans, anything. It can ruin you. So be very, very careful and very
Yeah.
selective.
Also, I want to say if you never purchased a home before and you become a non-occupant borrower, you lose the benefits of first-time home buyership. So be mindful of that too.
It's going to take 3 years to
3
get
years.
that little label again of you are a first-time home buyer.
If you're looking to get into Habitat, and if you have a Habitat home, you won't be able to get it because you've co-signed for a deed. And some grants, nonprofits, you won't be eligible for it because they're going to see that you had a name on a deed, even though you never lived there. So be mindful of that too.
Don't just be willy-nilly about it, and definitely
Yes.
take a lot of time and tell that to the person who's asking you for the help. Say, hey, I really want to help, but I really got to make sure that it's going to work out for everyone, including myself. And so I'm just going to take some time, sleep on it, do my own research, do my own due diligence in order to ensure that this is going to be good for everyone.
Right. And if they cannot accept your decision, and if they're rushing you and they're pressuring you, then that's the telltale sign that maybe I shouldn't.
Yeah, unfortunately, getting pushy when you want to take time, they should be nothing but understanding, especially what that means that you're going to be doing for them. I feel like that's not what you should be doing. If you really want someone to help you, you shouldn't be pushing them on and edging them on. And it can get real toxic real quick. So be careful. Be careful, be loving, be kind. We got down payment and qualifying ratio requirements for manual underwritten loans with the LTV and CLTV, LTV loan to value, and then combined loan to value is the CLVT or CLTV. Sorry, get my letters. So you got 80% there. You got the meeting the requirements for purchasing a 1-unit principal. Let's see, 2, use gifts, donated, grant funds, or funds received from an employer to pay for some or all the borrower's minimal contribution. So again, this is starting to dig into where are those funds coming from, and also like, hey, who's doing what on this loan?
But a donated gift fund, you just need them to sign a letter saying, hey, this is a gift. They don't have to pay it back, and that's it.
That's right.
Not where it comes from. As long as we have that letter. And your loan LTV, or again, just refresh your memories, your loan to value, calculate all your debt, divided by 12, calculate your loan, all your income divided by 12. Then we divide it together, we get that percentage. If it's equal or lesser than 80%, we're good to go.
But remember, always consider, am I going to be house poor if I make this decision? I can't tell you how important that is. Bathsheba and I, it is our job to say, yes, you can. It is not our job to say, no, you shouldn't. We can say that as professionals to say, well, I don't recommend it.
Right.
We can't ever tell you, no, you can't. Because if you can, you can. But the question then becomes, envision you make the decision. But now every freaking month you wake up and you realize you can't buy groceries because you're literally just paying all of your money to your shelter expense, your living expense, and in the home. That's not a good place to be. If you're down for second jobs, third jobs, side hustles, what have you, then by all means, but there's only 24 hours in a day. So you got to be careful and make sure it's going to be good. A lot of experts will recommend 25 to 33% being your monthly intake, that percentage being the amount that you spend towards your home or rent, mortgage or rent. But again,
that's unreal. The days we're living in now, that could seem unrealistic, but maybe it's time to live below your means. If it's 2 of you guys that live off of one check, and then the other check you can save to get you where you need to go. Because when you're buying a home is expensive, especially because you're borrowing other people's money. You're borrowing the bank's money, and they want interest on that. And then there's documentation that they want money on that too. So there's a lot of money. Like I say, closing costs is typically 5% of the loan on top of your down payments. So when you think about that, it's a big investment. It's worth it. It's better than renting, in my opinion. I recommend doing it, but set yourself up for success. Save a little bit will become much.
That's the whole analogy of like, when was the best time to plant a tree? Well, 10 years ago. Well, when's the next best time to plant a tree? Well, right now. Hey, check it.
I like that.
All right. Well, I feel though, another thing you should also consider is I'm going to get this home and I'm going to buy this home because I need to buy this home. It's like, well, I need to is real strong wording there. Like, is it really a need or is it a want? Because I think there's a lot of cases where it's probably a want. And as a loan officer, I should never be telling you, oh, renting is better. But at the same time, maybe renting is better for you. As someone who's trying to be a fiduciary, someone who's looking out for your financial interests, sometimes renting is better. And as you said, unrealistic, right? Bathsheba, you said unrealistic, 25 to 33%. And considering how expensive housing is at this moment in time, that can seem unrealistic. However, it's as realistic as it gets. And if you can't afford that, or it's going to make you house poor, you shouldn't do it yet. That's really what that means. I know not everyone's situation is the same. And I've heard a lot of people saying, well, loan officers just trying to get you, the real estate agents are just trying to get you because, they're only going to make their money. They're only make their bread when they sell that home. And I mean, they're not wrong, but at the same time, they're not right because, again, we're going to tell you, at least I know I'm going to say it, is like, hey, check it out. Can you get by with this kind of margin, right? How much are groceries? 200, 300 bucks every 2 weeks, or family of 4 for sure. That's minimal, probably. All these phantom costs, they'll talk about that too. Because it's not just, I can afford the down payment. I can afford the closing cost. Awesome. My DTI is good. My debt to income ratio is good. The loan to value is going to make the lender happy. We're checking all the boxes. Credit score is fantastic. The profile ultimately looks like it's going to be a good one. However, you have to remember there's going to be maintenance costs. That's a big one. And there's going to be upkeep. So the lawn, the trees, the fence outside that runs around. There's a bunch of things that go into it, a bunch of phantom costs, and you can't really know what those things are going to be. So a lot of folks recommend some sort of percentage that you set aside in your emergency fund that's intended for housing. Because, I mean, we talk about emergency fund. I saw a video recently about how a guy broke down an emergency fund. He's like, well, that's great. You've got an emergency fund. And they say, oh, 3 to 6 months of your income set aside. But here's the next problem. What is that all supposed to be for? Do you have a budget for your emergency fund? Do you? I don't. When I learned about that, I was like, well, I better get on that. So
I got it for an emergency. If an emergency comes up, I dip in it. If you lose your job, you can survive.
And what I'm going to try and do probably in the coming year is to try and put a budget in to the emergency fund. And so what I mean by that is you've got a certain amount for medical expenses. You've got a certain amount for car maintenance for that amount of time. Same for the house maintenance if you own a home. Same for medical emergencies. Like you just have to set percentages because you're never really going to know.
Right.
What's the comfortable percentage? You say, oh, well, it's going to be 5%. Awesome. So 5% every month. Okay, great. That's what because we're talking per month. And then if you've got that, and then you have a true emergency fund, because at that point, now, no matter what happens, you've literally got enough margin to last you no matter what happens. You've literally accounted for everything possible. And then don't forget to be insured, because boy, howdy, that's not great. Because even with that emergency fund on the side, you're really just looking out for like the copay. You're looking out for like, what's my deductible? You're not looking out for like, okay, there was a huge car accident that caused the entire highway to go out and there was 32 cars involved. So that was like multiple millions. No, you weren't accounting for that. And even though you're responsible, that's what umbrella policies are for. So if you feel like you need a lot more, make sure you're in the insurance game as well. The more you've got set up for the future, the better you will ultimately be, no matter what life throws at you.
Better to have it and not use it than use it, need it, and don't have it. And it's good to look at your previous years. Like if you want to get a good educated amount, how much did it cost you last year to fix your car? Is your car a newer car? Is it an older car? So that way you can see a projection for the future is by looking at the past.
It's not going to guarantee future returns or future incident. You're going to be in a better place than those who, I think it's like over 50%, right? Over 50% of Americans cannot afford a $1,000 emergency situation. It's probably more. I think it's closer to like 65, 70% of the overall population. If that happened to them, they got to go in debt. And so that's not great. So don't be a part of that statistic. Definitely set aside money. Start low, work your way.
And if you are, you can change right now. Today's a new day. Start putting $20 away, $10 away, $5 away, and just be consistent and watch it grow.
Set aside something. Pay yourself first is what a lot of people like to say. First. That's right. Because remember, like on the plane, right? You got to put on your own mask first before you help others.
Yes.
Same exact logic. This talks about more of the loan to value ratio requirements for manually underwritten. I go into those details, but I feel like if you have to manually underwrite something, it's going to be a special scenario case.
Very special.
None of this is really going to be applicable except for when you have to do that. So if you don't have like one of those really crazy out there scenarios, you're probably never even going to see any of this. And then DU also apparently, okay, then the opposite is going through DU as opposed to manually underwriting. So having the machine do it versus people. That's what it's talking about here. And you can even see that it's just like the only thing they have in this entire section for DU is the 95%. Saying that the LTV loan to value ratio, combined loan to value ratio, and the home equity combined loan to value ratio may not exceed 95% unless you have these conditions of community seconds and it's a part of the transaction. And as you can see, it's very, very specific. And so I feel like if that's you, then we will be talking more and learning more at that time, because this is not, most people it's going to be DU or if we're doing Freddie Mac, LP, as we've been talking about, it's going to tell us yay or nay and for what reasons. And then we're going to pretty much go from there. So as far as eligibility goes.
So if you have any unique scenarios, give us a call. I'm in Florida, David's in Texas, and we will go through your scenarios together. So don't think your scenario is unique enough where, oh, we can't help you. Let us know. We'll be happy to help you.
So yes, I will put all of our information on the screen right now to Bathsheba's point. So that way, if you need to reach out to us, you totally can. So information is on the screen right now. And we have just talked about 4 different parts of the borrower eligibility. I hope you learned a thing or two. I know we got some tidbits in there too, some golden nuggets of knowledge. Put your comments below this video if you want us to talk about anything else in the future, or what your thoughts are about this video, what we could have done better. All of your feedback is a gift ultimately. As we land the plane here, Bathsheba, what are your concluding thoughts?
I'm just so happy to be here again. Thank you guys so much. Give us a call. We're here to help you. If you have any topics you want us to talk about, send it out to us so we can talk about it some more.
Absolutely. Make sure to like and subscribe and give this video a share for those who are maybe in the housing market right now. They're trying to buy a home. They want to get some more knowledge, or maybe got loan officer buddies who are trying to get through these guidelines and they want to do it in a bit more of a fun environment. Definitely worth a watch. And other than that, guys, this has been Dave, Bath and Beyond. My name is David Dowd. This has been
Bathsheba Payoute.
And we appreciate you guys checking us out. Hope you have a blessed day. Take care for now, guys.
Bye.